I let Rachel thank our distinguished speakers later. I have a logistical announcement. You know how they switched the session with Petrassi? Guess what happened? They gave us a wrong iPad. So when you were sending your questions through the app, Petrassi got all your questions. So we hope that this will get sorted very quickly. But until then, we have a microphone. So if you have a question, please come forward and we can deal with it this way.
Thank you, Alina. Well, we might need the lights up a little bit so I can see who's got a question in the audience. But firstly, I'd like to thank our speakers again. Thank you very much for a most informative session. Secondly, the statements by Sir David about our friends from Wales and the US don't necessarily reflect the thoughts or views of our other panel members, so please don't take that out on us. But I love it when our panellists have a debate. And Mauro said that he believed that valuation be a science, and yet Doug said he felt it was more of an art. From my own perspective and my time in mergers and acquisitions, there was always such a vast range, and the investment bankers love to tell you, what all the different parties put in after a few weeks after the event. And so the range, as Sir David pointed out on 3 different examples, could have been many billions of dollars. So I'll put it back to April firstly and say, what's your view? Do you think the valuations is an art or a science?
I think it's got to be both. I think there has to be an aspect of science and narrowing the methodologies to get rid of the outlying methodologies that give that huge range and narrow it down. But you're only going to ever be able to get it to here because then the art takes over, the judgment aspects take over. So I think it's very much both.
Okay, and Sir David, do you want to do a tiebreaker here?
Well, I agree with April. I think if you take financial instruments, you'll never get the values down to 3 decimal places. But what we have to do is get them down from the vast differences that do exist at the minute, and there's unpublished figures that we've seen, and bring them down to a much narrower range that's within acceptability. Otherwise, I think you have to start casting doubt on the balance sheets and income statements of some financial institutions.
Okay, thank you. Has anybody, we've got a question, Alina, in the second row here.
Test. Thank you. My question is for Sir David Tweedy. I was wondering if you could answer a question with regards to the role of integrated reporting in valuation and regulation and whether or not you see it as relevant issue now.
Well, I think it's definitely coming. In valuation, I think it's hard to say exactly what's happening because we are still struggling with the present format. After that, yes, I think as you move into various aspects, cost is not going to be a great issue. It's not going to be very helpful. You're going to have to move away from cost and you're going to be into value all the time. I remember when I mentioned David Flint, one of the first things he did, he took the apprentices, as we were then, CA students, away every month, and we used to just discuss accounting problems. And I remember him saying, write your own balance sheet. Well, if you asked the rest of the world to write their own balance sheet, they would not use cost, they use value. And people think in value terms. People here will not think in terms of their house, in terms of what they paid for it 15 years ago. It's value. And that's the way accounting is going to go. So I can just see it becoming more and more important.
Thank you. Any other questions?
Good afternoon. My name is Hamza. I'm from Sri Lanka. Now, in the case of application of standards as far as third world countries, there are some limitations. So how we overcome global consistency? I think any distinguished guest can answer that.
Sure.
Who wants to take that one? Doug?
Yeah, sure. Happy to. I mean, I spent 2 years, 2009 till 11, in the Middle East, so that's a pretty relevant question. I think, again, it goes back to the point around if you have global standards and hopefully they're applied properly, you will over time drive consistency. Are you there today? I don't think IFRS is there completely today. I don't think valuation is there completely today, but you're moving in the right direction towards a more consistent approach in terms of fair value. I think in a lot of the emerging markets as well, what I've seen recently is that the regulators are getting tougher, and in some cases tougher than regulators in Western Europe. And you can see that through some of the stats that Mauro, Professor Binney had up earlier around market cap versus book value for developed Western markets.
Thank you.
Hi, I'm Nina. I'm from Trax Technology. We're into image processing of images, and then through the algorithms, then we come up with analytics data useful for decision making. My question here today is how would the panel value data that is compiled and consolidated on competitors, the industry, the customers? What are techniques and that you would use in order to put that value into the balance sheet?
Who would like to take that one? It's quite a difficult question. Mauro, do you want to have a go at that from an academic perspective?
Of course, data are the basis of valuation. The problem is that if the data are complete, in the sense that you need a complete basis of information to do valuation, and the quality of data many times is not known, very well known by valuer. This is a problem. So the problem is that many times information provider give to valuers information that are a sort of elaborated information that are not directly elaborated by the valuer, and this is a risk for the valuer, because the valuer can conceive his role just a final step of a long process that starts from raw data to the final result. I think that the process must be integrated, and if we have a sort of specialization of the valuer just in the final step of valuation, this is a risk. And perhaps we will have poorer quality of valuation. This is my opinion. I don't know if Doug is...
Doug, do you want to add
agree.
tomorrow?
Yeah, I mean, it's difficult with, I mean, it's a typical fair value question we'll have around any intangible asset. You can't touch it. You know, how do you measure it? You know, does it exist? At the same time, you would say most companies are spending immense amount of money on data and analytics today, as they are on things like cybersecurity. And clearly, if you're spending that money, you must see some benefit coming out of it in the future. Are they easy to value? No. Could you value those items? If you had time and access to data, you should be able to, in my view.
So David, did you want to add anything on that?
No, I'll keep out of the intangible area.
April?
Well, not in the intangible field, but we see the same challenge that Mauro mentioned about the risks to the valuation profession in the real estate valuation area surrounding data. What we're finding is in developed markets that the data providers are gathering that information and putting a price on that data, making it much harder for the valuer to access the data. And without good quality inputs, you're not going to get quality valuation out the other side. And the accumulation of data in certain forms is producing mass appraisals. And the risks to mass appraisals is that you're not getting the art part of the valuation supported by the scientific part, which is that you need the other observable, market observables, and the judgmental aspects brought in. So there's an important role for data. In some economies, emerging economies, you're not seeing enough quality data available. So there's a nice balance in there somewhere, but the quality of the data is very important, and that it be verifiable at a reasonable cost by the valuer.
Thank you, and thank you for that question. I think it's going to be very relevant.
My name's Andrew Liskin. Question, I think, probably for Sir David. If we move towards fair valuation on the balance sheet, as volatility exists in valuations, how do we explain to the general public the significant volatility in P&L that will arise from that?
Well, I think it depends where you go to with fair value. When I was on the ISB, we used to have what we call Fair Value Corner. There was 3 board members who would fair value everything, including their mother, just put the... everything. Well, if we'd done that in accounting, British banks, they would have shown from 2000 to 2006, they would have shown more volatility, as you say, and their profits would have been 100 billion higher. In 2008, they would have lost 300 billion extra on fair value as the loan book collapsed, and that would have peaked in 2009 at 400 billion. Well, the total resources of the British banking system was 280 billion, so all our banks would have been bust on a fair value basis. A few months later, we're back in the black again. So I think that's why you found the accounting standard setters are only targeting areas where they think there is a real sense of the value encapsulates what this thing is worth. Now, a loan, provided the guy hasn't gone bust and he keeps paying his interest, he can still get it. So that's why you've got in accounting IFRS 9, certain assets can be kept at cost. And the volatility, I think, when you're dealing with things like derivatives, and we know there were some countries that argued, let's not have value for derivatives. Well, they don't even have a cost. It's a contract. So there'd be nothing. Meanwhile, off balance sheet, massive gains and losses. And when those blew up, it would be, where's the accountants? Well, the accountants are there. They're on balance sheet now. And the same thing goes for equities. And I think people understand. The stock markets fall. If you've got investments, they fall too. Your pension fund falls. That's understandable. I think what we have to do is make sure accounting doesn't get into areas where people just doesn't see it makes intuitive sense. Most of you are too young for inflation accounting. But I remember in the UK we had things like monetary working capital adjustments, and you'd look at the client and there'd be an answer of 50 million. You say, is this a plus or a minus? Didn't mean anything. So I think if you relate fair value to things that are obvious, like equities, derivatives, that is understandable. If you start taking it down to some other levels, plant and machinery, who needs that? We didn't go there. And that's going to be one of the big debates. The academics will probably tell you they all be at fair value. Okay, well, the British banking system would have been bust in that case. So it's where you draw the line.
Hello. My name is Dorothy Berg. My question is in the same context of financial instruments. How do you value the securities lending if the valuation of financial instruments is already quite subjective?
What was that? How do you value what? Sorry, would you repeat that question? I'm not going to answer it, but if you just repeat it then.
How do you value securities lending?
Securities lending?
Doug, do you want to take that one?
It's not a huge area. My specialism, I'm a bit more business and tangible assets. But do you mean just in the context of the volatility that comes through in that business?
Do you mean the volatility in the business, or do you mean like a securitized portfolio that with different loans inside it?
I mean, if you, for example, as a pension fund, you do the securities lending, meaning you lend securities to obtain a certain percentage afterwards, but you lend securities, but you need to evaluate them to know on which basis you calculate your interest. So if the valuation of financial instruments is already difficult, how can you make sure that you disclose the correct value?
Yeah. Well, I mean, I think it is a challenge.
Well, okay,
so, but I mean, I'll give you maybe an analogy. So I worked on the Bank of Cyprus, which went through a 10 billion bailout by the IMF, the ECB, and the EU, right? And that had some similar issues where you had significant financial securities in a country that, the banking sector represented a significant amount of the economy, and that banking sector collapsed. And so when you're looking at loans, really a lot of what you're really trying to go down to is what's underlying the actual loan itself. What is it? Is it a piece of real estate? Is it a business? What sits underneath that? And that's part of the issue, I think, when David talks around the problems around financial instruments is often there's a lack of looking at what underlies that actual instrument. So if the loan's experiencing stress and the asset that underlies it is in real estate and that's impaired, you got a real problem. And there's a big measurement issue there. And I think the banks still haven't got that anywhere near right to today. It is hugely, hugely subjective and time-consuming. I think part of the issue comes down to trade-off. It's the kind of timeliness, cost relevance issue you always face in accounting.
Does that help you? We've got another question over there, Alina. Just through here, yes?
Good morning, my name is Titi Akibayo, Institute of Chartered Accountants of Nigeria. My question is, what is our worry here? Is it the gap that we have in the valuations, or just that there's no standards? Because really, valuation becomes very important in a matter of buy and sell. And we will negotiate and find the price reasonable for the buyer and the seller. But we are worried now that we don't want accountants to be blamed because of the varying variation in the valuation that we're getting. Oh, can you explain to me why we're going through this process? Thank you.
Well, after that introduction, basically, the situation when you look at why we're worried, just this week, the Financial Stability Board announced that banks, as they've been doing since the crisis, are having to increase their capital levels. Secondly, they announced that next time round, the government will not come in to help them. This time, the debt instruments are going to have to take a haircut. Well, that's fine. They could have done that last time too, but they didn't, because if they'd blown the debt instruments up, then it brought even more institutions down. But basically, the concern is that if you have banks that are valuing some instruments, and some are at twice the value others are, and if you've got a level of equity, which is about, say, 3%, if you took the aggressive bank and actually applied the more conservative values to its portfolios, some of them have their equity wiped out. And that's the risk. There's a potential crisis in the making because of the valuations. People aren't sure where it is. And that's what worries me about it. We've been there once in 2008. Let's clean it up so we know exactly where the risks are.
Mm-hmm. But Rachel, if I can add to David's description there of the banking situation, the banking risks, there are very, very many situations where you don't have a willing buyer and a willing seller to determine a price. So there's a huge difference between the price of something and the valuation of something in certain circumstances. Because some of the examples that I gave around when the government comes along and compulsorily takes your land to give to a third party or to undertake an infrastructure project, it's very important that the individuals whose assets, land, buildings, those are appropriately compensated. And you need rigour around the valuation from the technical aspects and the valuation standards through to the professional aspects to know that the individual undertaking that valuation exercise to protect the individuals and to reach a fair compensation are appropriately qualified, educated, and apply to ethics and are appropriately independent. And there are many examples of environments, taxation situations where you haven't got a willing buyer, willing seller situation. So you've not always got that negotiation. And David's given one of the biggest risks areas as an example.
Thank you for that addition. April, I'm going to ask you what I think will be the final question based on time, and given just the relevance and timing of the APEC meeting that you mentioned a few weeks ago in terms of the business component of that, but with the G20 next week and all those countries that you rattled off, so many of them are part of that. Mm-hmm. What for this group is your aim or targets with the G20?
Currently, we're focused on APEC because of the overlap with the G20, and we think it's appropriate to focus in on one region. We believe that the nature of the economies in the APEC region lend itself very nicely to our ultimate goal of the development of the valuation profession and the convergence around robust global standards. So we will focus in on APEC and then hope that those key APEC, or plan that those key APEC initiatives, and then take that on to the G20.
Perfect, thank you. Well, you have a lot of challenges ahead, and we are thrilled that all 4 of you are taking such a leadership role in this. Ladies and gentlemen, will you help me thank our panellists today? Thank you.